It's been tested just a few semesters back.
Hello and welcome back to the lesson. Today's focus is on international standards on auditing, on audit planning. There are many international standards on auditing. One such standard deals with audit planning, and the primary international standard on auditing that deals with audit planning is International Standard on Auditing number 300. ISA 300 is the primary standard, international standards on auditing, that deals with audit planning. It is the core standard. Though there could be other standards that are related to planning, ISA 300 is the core standard on audit planning. And in this lesson, we are going to summarize some of the key requirements and guidance from ISA 300. So the objective of the auditor is to plan the audit so that it will be performed in an effective manner. You understand? So ISA 300, the standard is known as planning an audit of financial statements. Planning the audit of the financial statements. ISA 300 is about planning an audit of financial statements. Objective of audit of the auditor, ISA 300. The objective of the auditor is to plan the audit so that it is performed in an efficient, effective manner. So what are some of the requirements or the guidance of this standard 300 on auditing? Okay, on audit planning. So one requirement is involvement of key engagement team members. There has to be involvement of key engagement team members. Involvement of key engagement team members. The standard emphasizes the involvement of key engagement team members in planning of an audit. The engagement partner and other key members of the engagement team are required to be involved in planning the audit, including planning and participating in the discussion among engagement team members. And this emphasizes the importance of experienced personnel being involved in the critical planning phase. The second requirement of International Standards on Auditing 300 is preliminary engagement activities. Preliminary engagement activities. Preliminary engagement activities. Before establishing the overall audit strategy, the auditor is required to perform various activities at the beginning of the current audit engagement. For example, performing procedures regarding the continuing of the client relationship and also specific audit engagement. There is evaluating of compliance with the relevant ethical requirements. There is the aspect of establishing an understanding of the terms of the engagement. So that is the second requirement of ISA 300. The third requirement is in relation to the establishment of the overall audit strategy. Overall audit strategy. Now, what does the standard say about establishing overall audit strategy? The auditor is required to establish an overall audit strategy that sets the scope, timing, and direction of the audit, and that guides the development of the more detailed audit plan. Understand? Establishing the overall audit strategy. In our previous sessions, we defined what an audit planning strategy is. Let's move on to the fourth requirement of ISA 300, which is developing an audit plan. Developing an audit plan. Developing an audit plan. That is to say that the auditor should develop an audit plan that includes the description of the nature, timing, and extent of planned risk assessment procedures. That is very critical. Then, of course, we have documentation. Number 5, the standard is also not silent on documentation. The auditor is required to document the overall audit strategy and the audit plan, and any significant changes made during the audit engagement to the overall audit strategy or the audit plan, and the reasons for such changes should be documented. You understand? And that emphasizes that planning is an iterative process. After the strategy has been developed, the plan has been developed, but there could be changes along the way. So such changes have to be documented. Documentation. Then there is consideration in initial audit engagement. Considerations. 6 considerations in. We have the other aspect of ISA 300 is considerations in initial audit engagements. Considerations in initial audit engagements. This is also one of the requirements of International Standards on Auditing 300 on planning. For initial audit engagements, the auditor has additional considerations. Initial, if you are auditing a company for the first time, that's what we are calling initial audit engagements. There is the continuing engagement and initial engagement. For initial audit engagement, the auditor has additional considerations, including performing procedures regarding clients' acceptance and continuance. There is also communication with the previous or predecessor auditor, if any, in accordance with the relevant ethical requirements. So the planning standard, the standard on planning requires that the auditor to conduct further procedures if the engagement is new, like contacting the predecessor auditor and carrying out other procedures in that regard. So that is it, candidates, for this standard. The International Standards on Auditing on Audit Planning, that is ISA 300. We've in this lesson discussed some of the requirements and guidance of the standard. One is in relation to involvement of key engagement team members. Number 2, preliminary engagement activities. The standard also provides guidance on establishing overall audit strategy. Number 4 is development of an audit plan. Number 5 is documentation. And lastly, considerations in initial audit engagements. And that's the end of the lesson and the end of the topic in principles of auditing. Bye-bye. Greetings, candidates. Welcome to the study of the subject leadership and management. And in my hand, I have the KASNEB syllabus that was released in 2021 KASNEB revised syllabus for paper number 13, Leadership and Management. This paper was renamed from Strategy, Governance and Ethics. And in our today's lesson, I'm going to do an adumbration of this subject. The unit description is as follows. The syllabus reads that this paper is intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to apply and demonstrate leadership and management skills to grow an enterprise under various circumstances and environments, including under uncertainties. That is the main objective of studying leadership and management. It is to equip the candidate with knowledge, skills, and attitudes that will go a long way to enable the candidate apply and demonstrate leadership and management skills in order to grow an enterprise under various circumstances, various environments, including uncertain environments. The syllabus also lists 5 learning outcomes. A candidate who passes this paper should be able to, number 1, demonstrate an understanding of leadership techniques and management principles. Leadership techniques and management principles. Number 2, apply knowledge of leadership and management theories in organizations. Number 3, effectively undertake management functions. Number 4, make rational management decisions in an organizational context. Then lastly, embrace and manage strategic change. These are 5 learning outcomes. Now, candidates, the content is organized in 12 topics. 12 topics. The first one is Introduction to Management. Number 2, Evolution and Development of Management Thought. Number 3, Leading as a Function of Management. Number 4, Other Functions of Management. Number 5, Environmental Analysis. Number 6, Leadership Approaches and Strategy. Number 7, Decision Making. 8, Enterprise Management. 9, Project Management. 10, Marketing Management. 11, Leadership and Strategic Change. Then lastly, Case Studies in Leadership and Management. Case Studies in Leadership and Management. These are 12 topics. 12 topics. And candidates will be covering each topic at a time. Each topic at a time. For example, the first topic, Introduction to Management, we will study the nature of management, importance of management, levels of management, multidisciplinary nature of management, roles of management as advocated by Henry Mintzberg, the changing roles of managers and management, qualities of an effective manager, management and administration. These are the subtopics under the first topics. Then in topic 2, there are 3 categories of evolution and development of management thought. Is organized in 3 subsections. Number 1 is the classical approaches to management. Number 2, behavioral management approach. Then modern management theories. The third topic, leading as a function of management, will study differences between management and leadership. We'll study attributes and skills of a good leader. We look at the delegation, responsibility, and accountability. Then we will cover power, authority, and accountability. In topic number 4, which is known as other functions of management, we will discuss the planning function, the organizing function, the staffing function, and the controlling function. Topic number 5, which is environmental analysis, we are expected to cover microenvironment, macroenvironment, internal environment,
external environment and tools of environmental analysis. Then in topic number 6, leadership approaches and strategy, we look at the leadership traits, leadership styles, leadership skills, formulation of an organization's strategic direction, differences between transactional leadership and transformational leadership, conflict resolution mechanisms, then ethics in leadership. In topic number 7, we'll discuss the importance of decision-making models, types of decisions, decision-making process, problem-solving skills, decision-making under different conditions, challenges in decision-making, effective, and lastly, effective decision-making. In topic number 8, we are expected to study the meaning and concept of entrepreneurship, entrepreneur development, enhancing creativity and innovation in organizations, methods of generating ideas, introduction to business plan, protection of intellectual properties. That is the last subtopic in the study of enterprise management, protection of intellectual properties. In topic number 9, candidates are expected to cover number 1, project management concepts. Number 2, characteristics of a project. Number 3, importance of projects. Number 4, features of projects and baseline surveys. Number 5, illustration of the project life cycle. Number 6, project planning and organizing. Number 7, project resources and costing. Then lastly, number 8, project completion and evaluation. In topic number 10, known as marketing management, we will discuss the meaning and importance of marketing. We will look at the marketing management orientation and or philosophies. We study the marketing mix. We'll discuss the development of marketing information. Number 5 is the marketing strategies. Then we have marketing research and intelligence. And lastly, international marketing and e-commerce. Topic number 11, leadership and strategic change. We will consider the meaning of change, theories of change, types of organizational change, managing resistance to change, organizing the change context, levers for strategic change, methods of introducing strategic change, problems of formal change programs, leading change is the last subtopic under leadership and strategic change. Then lastly, there is a case studies in leadership and management. Case studies, we will discuss or look at different case studies in leadership and management. So candidates, these are the areas that you are expected to study in your endeavor to gain knowledge, skills, and attitudes that will enable you to apply and demonstrate leadership and management skills to grow an enterprise. And that should be done under various circumstances. You are expected to manage an enterprise under various circumstances and environments, including uncertain environments. So I hope, candidates, you will be joining us in all the lessons. We are going to cover each and every aspect of this syllabus. It is expected that as we go through this syllabus, when you join these classes, make sure you take down notes. If you have questions, you are free to post your questions. Below this syllabus, there is a comment section where you can ask questions. Make sure you also practice active recall. Carry out continuous revision. Over and above the video lectures, we have also developed the study materials, study texts, and revision books based on the revised syllabus that was promulgated in the year 2021. The books are updated and they cover all these areas that we've mentioned. So make sure you study ahead. Study ahead. Always study ahead. Make sure you familiarize yourself with the various aspects of the syllabus, and as we progress with this coverage of this syllabus, make sure you always go back, answer questions, past paper questions, because some of the topics in leadership and management were retained, because I remember I said that this subject, leadership and management, was just renamed. In the old syllabus, the paper was known as strategy, governance, and ethics. There are certain topics that were maintained, like the first one, introduction to management. There is a topic on evolution and development of management thought. Other functions of management were also retained, like the planning function. We covered it in the previous syllabus, organizing function, the staffing function, controlling function, and even leadership approaches and strategy. These are some of the topics that were retained in this current syllabus. All right. The only new topics that were introduced here I can see is enterprise management. Some subtopics are enterprise management. Project management is also a new topic, including marketing management. Though candidates in the old syllabus, when some of us were studying this course, we studied project management and marketing management. These topics have been reintroduced in the syllabus. So you can see, candidates, we have past paper questions from these areas that I've mentioned. So as we progress, make sure you revise, look at the past paper questions from our revision partners. Check our revision partner. We have past paper questions with solutions. So as we progress with the coverage of this syllabus, make sure you carry out continuous revision. Don't wait at the last minute in order to revise. No. Continue revising. When, for example, when you are done with topic number 1, go to the revision books, look at the questions that have been tested in the past under this topic, because in the revision books, we have organized the questions topically. So it's very easy for you to locate questions based on the topic that have been that we are covering in the subject leadership and management. So candidates, thank you for choosing to study with the Manifesto Publishers. We endeavor, we plan, we are ready to help you gain the required skills, the required attitudes and knowledge that will enable you meet the objectives that I read here. Remember, by the end of this training, number 1, the syllabus states that you should be able to demonstrate an understanding of leadership techniques and management principles. Number 2, you should be able to apply knowledge of leadership and management theories in organizations. Number 3, you are expected to effectively undertake management functions. Number 4, a student or candidate who passes this paper should be able to make rational management decisions in an organizational context. Then lastly, you are expected to embrace and manage strategic change. It's not just about knowing the principles or memorizing a few concepts. No, at the end of the training, it is envisaged that you should embrace and manage strategic change among the other objectives that I have read. So that is our intention. That is our purpose, to equip you with the knowledge, with skills and attitudes that will enable you to apply and demonstrate leadership and management skills that will enable you to grow an enterprise under various environments or circumstances, including environments and circumstances that are uncertain. So you can see, candidates, the training is not limited to you passing the exam. The skills that you gain here should enable you to demonstrate, to practice, to manage, to apply, to embrace, to make rational management decisions in an organizational context. So thank you one more time, and hope to see you as we continue studying leadership and management. Bye-bye.
I greet you all and welcome you back to the Manifested e-learning platform. The subject is meetings. We are studying the governance standards and guidelines. Today we are moving to guideline standard number 006 on registers and records. Governance standard GS 006, registers and records. This is a standard that governs the corporate memory. We are talking about records, candidates. Previously, we studied minutes and resolutions, which record decisions. Minutes, resolutions. Minutes is a record of what transpired in the meeting. Right? Resolutions, we say these are the decisions that are made during the meeting. Today we are moving to records or registers. Registers record the status and identity of company stakeholders. They record the assets of the company and legal obligations. And under this standard, the company has a statutory duty to maintain specific books that are accurate, that are up to date, and available for inspection. That is the requirement of this standard. Understand? Yes. Registers and records. The standard ensures that the company remains transparent to the regulators, to the shareholders, and also to the creditors. It is a legal requirement. The company has no option but to maintain records and registers. So first of all, let's analyze the statutory registers, which is a mandatory requirement. Statutory, number one, statutory registers. Every company is legally required to maintain certain statutory books or registers. This is mandatory. Mandatory. The first book is known as Register of Members. Register of Members. Members are just the shareholders. These are shareholders. Register of Members. The definitive record of who owns the company is what we are referring to as the Register of Members. That's the first mandatory book that is required to be maintained by a company. Who owns that company? We can tell the owner of a company by reading the Register of Members. Who owns the company? A person is generally not a legal shareholder until their name is entered in this register. Until your name is entered in a register of members of a company, you cannot claim to be a member of a company. It is a statutory register. You want to tell the owners of a company, then you make reference to the register of members. There you will find the shareholders of the company, those who own the company. That's the first book. The second register is register of directors. Register of directors and secretaries. These are the officers of the company. The officers of the company. Register of directors and secretaries. This register details the leadership. It provides the details of the leadership, including their names, their addresses, their dates of appointment, and also resignation. If they resigned, if you are a director of a company and you resigned, that record, you can find it in the register of directors. You are appointed, then you must appear in the register of the directors and secretaries. Then the third book is register of directors' interests. Register of directors' interests. The company is also under legal obligation to maintain a register of directors' interests. This records any shares that is held by directors or contracts where they have a personal stake. If you are a director and you own shares in the company, that has to be part of the register of directors' interests. If you are a director and there is a contract that was issued to you, or a contract where you have interest, then that has to be part of the register of directors. That's the third statutory register. Or register of charges. This is yet another important register, the register of charges, and this could also be mortgages. Register of charges or mortgages. This is a list of companies' assets that are used as security or collateral for loans, and this register is crucial for the creditors. If the company has taken loans and it has charged the company's assets, then that information must be recorded in a register of charges. Those assets that are used as collateral must appear in the register of charges and mortgages. Understand? Yes. 3. Register of beneficial owners. The register of beneficial owners is the 5th register, which identifies the persons with significant control who may own shares through holding companies or through trusts. Those who have significant control. They could be owning the shares of a company through other companies, and that has to be documented in the register of beneficial owners. Register of beneficial owners. Understand? Yes. So these are mandatory registers. Mandatory statutory registers. Then let's discuss location and inspection rights. Location and inspection. Location and inspection rights. We are talking about the inspection of these records. First of all, we have identified the records. So we want to discuss to analyze the location and inspection. Now, GS006 defines where these records live or are located and who can see them. And the first location is the registered office. 1. Registered office. The registered office. Records must typically be kept at the company's registered office or a designated single alternative inspection location. If it is not the registered office, then it has to be the designated single alternative inspection location. So that is where the records are required to be kept. Then number 2, we have public inspection. Public inspection. Public inspection. Shareholders usually have a right to inspect registers for free, but the general public may often do so for a small fee or upon stating a proper purpose for wanting to inspect the documents. 3. Digital versus physical. Digital versus physical. Most modern standards allow for digital registers, provided they are secure, they are backed up, and can be printed upon request. So if the records are digitally located, then the records should be printable. The records should be secure, and they are supposed to be backed up. There ought to be a backup for the digital records. You understand? Yes. So this is ABC. ABC. Then 3, retention. Retention. We have to discuss retention as per GS006. Retention. How long must records be kept? Now, while laws vary by region, the standard generally allows for certain benchmarks. Okay, we are going to have the benchmarks here. Let's have a column for record type. And have a column for record type, then another column for retention period. Retention. The laws of the country may give direction or provisions on a retention period. So the laws vary by jurisdiction, but the standard 006 registers and records, they provide a benchmark. So let's begin with the statutory registers. The first record type is statutory registers. Statutory. The statutory registers, they Retention period for statutory registers is for life. These records are stored permanently. The record cannot be deleted. It is retained for the life, permanently for the life of the company. Before the company dies, these records must be maintained. That is statutory registers. These ones here. Register of members, register of directors, register of directors' interests, register of charges, register of beneficial owners. Permanently retained. Then we have minutes and resolutions. Minutes and resolutions are often permanently stored, but at least 10 plus years. This is 10 plus years, 10 years, 11 years, or permanently. That means they are not stored for less than 10 years. 10 years permanency. Then number 3, we can have accounting records. Accounting records. This could be the income statements, the financial statements. Accounting records are required to be kept. The standard recommends 6 to 7 years. They have to be kept for a period of at least 6 to 7 years. Employee records. Employee records be kept for a period of 4 to 7 years. 4 to 7 years post termination. After termination of a contract of employment, then the record of the employee has to be maintained for a period of not less than 4 years and not more than 7 years. 4 to 7 years. It will be 4 years, 5 years, 6 years, or 7 years at least. So that is information on retention periods. Retention periods. Then candidates, let us discuss the role of the corporate secretary, because the secretary plays a key role when it comes to registers and records. In fact, the corporate secretary is the custodian. The custodian. This candidate is just retention periods. This is retention. Let me title this as retention of records. The record type is here. So what is the secretary's role? This is number 2, number 3, then number 4, role of the corporate secretary. This is the role of the corporate secretary in relation to the registers and records. Now, under GS 006, the secretary is the custodian of the records. The corporate secretary, the company secretary, is the custodian of corporate records, of company records. And their duties include updating. The duties include 1, the first duty is to update the records, updating the records. The secretary should ensure changes like the share transfers are recorded within the legal window. And the legal window is most of the time 14 days. All right? Updating. Before we talk about filing, there is validation. Validation. Before the documents are filed, the company secretary has a role to carry out validation to verify that information provided by directors and shareholders is accurate before entry or before filing. Before entering information in these registers, it is the role of the corporate secretary to ensure that the information is accurate. Then number 3, filing. Filing. It is also the responsibility, the legal responsibility of the corporate secretary to notify the national registry, like the register of companies, whenever a register is updated. Whenever a register is updated, the corporate secretary is to ensure that that updating, that change is communicated to the registrar of companies. Okay, that's the end of today's lesson on governance standards. Governance standard number 006, registers and records. In this lesson, we have identified the statutory registers which are mandatory. 1 is register of members, 2 register of directors and secretaries, 3 register of directors' interests, 4 register of charges and mortgages, 5 register of beneficial owners. We've also discussed the location and inspection rights of these records. These records we've seen must be kept at the registered office of the company. There is also public inspection. The shareholders have a right to inspect these records without any charge. The members of the public may be required to pay a small fee or to state the reason why they need to inspect the records. We've also made mention of digitalization and physical of these records. We say that if the records are digitally kept, then they should be secured, they should be backed up. These records should also, the company should ensure that the records are safe, right? Then there is retention. And of course, in this lesson, we have studied the retention periods. You have retention periods. For statutory registers, they are permanently retained as long as the company is in existence. Then we have minutes and resolutions which are retained for a period of 10 plus years. Accounting records are kept according to the standard between 6 to 7 years. Employee records 4 to 7 years post termination. That is, after termination of employment, these records must be kept for a period of 4 to 7 years. Then we've, in closing this lesson, discussed the role of the company secretary. The first role is updating, validation, and then filing. So it's important, candidates, that a company maintains these registers, because failure to maintain these registers is often a criminal offense for both the company and its officers. And in many jurisdictions, the register of members is the only evidence of the title to the shares. So if it is lost or inaccurate, then ownership disputes can paralyze the company. So thank you for attending this lesson on GS006, registers and records. We'll continue to learn more on governance standards and guidelines in our next lesson. Important for you to also remember that over and above the video lectures, we have prepared for you study texts which contain notes for the entire syllabus. We also have revision books where we have answered past KASNEB question papers. The answers are topically arranged in the books. All these materials are available in hard copies. You can visit our shop or you can place your orders using our official lines. Thank you. God bless you. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing with the topic of group account, and in this session, I want us to look on another concept of group accounts, and the concept is changes in group structure or disposal of interest. So when we talk about the disposal of interest, or basically changes in group structure, this whereby the parent company will sell all the shares held in a subsidiary, or basically sell part of the shares and retain some of the shares held in such what? A subsidiary. So therefore, what we're going to do here is we're going to look on how to prepare the group account whenever there is changes in the group structure, or basically we have now the disposal of what? Of interest. But before we even do that, we can have an introduction to this, and we say that changes in group structure occurs when the parent company sells the whole or part of shares, whole or part of shareholding in the subsidiary company, subsidiary company. So basically that's what we refer as the disposal of interest. So the parent company here will sell some of the shares, or basically all the shares which are held in what? Which are held in a subsidiary company. Now generally the disposal of interest can be broadly classified into two main categories. First of all, we have what we refer as a full disposal. A full disposal is whereby the parent company sells all the shares which are held in a subsidiary. That is a full disposal. But on the other hand, we have a partial disposal whereby the parent company sells some of the shares held in a subsidiary and retain some of the shares. So therefore here we can talk of types of disposal of interest, types of disposal of interest. So when we say there are two types of this, we say disposal of interest can either be, number one, we have the full disposal, and then we have the partial disposal. Disposal. But in accordance with the International Financial Reporting Standard number 3, a disposal of interest basically occurs when the parent company loses control. So mean that once the parent company sells some of the shares which are held in a subsidiary company, and the parent company now loses control. So mean that the shares which will be held by the parent company in the subsidiary falls below 51%. So actually from 50% to 0. That is the time the disposal is deemed to have occurred in accordance with IFRS 3, in which case then the parent company is required to determine something called the gain or loss on disposal. So therefore the gain or loss on disposal basically is determined when the parent company loses control. So therefore you can say according to IFRS 3, International Financial Reporting Standard number 3, disposal of interest occurs when the parent company loses control. The parent company loses control. So basically what that means is that the shares now which are retained by the parent company in the subsidiary, or basically the parent company will sell some of the shares and retain shares which are less than 51%. So that is the time the disposal take place. And in such a case, then we are saying the parent company should proceed and determine the gain or the loss on disposal. What is important, therefore, to note as far as that point is concerned is that if the parent company has retained a control, when talk about retaining a control, this whereby we can be told A Limited, which held 80% of the ordinary shares issued by B, the parent company, we can be told, like sold like 20% of the shares. 20% of the shares. What does that mean? It means that the parent company has retained 60% of the shares in what? In B. In such a case, you can see the parent company still having a control, because we said a company or an investor company will have a control of the investee, whereby the shares held by the investor company, the investee company, lies between 51% to 100%. So, but you're saying disposal in accordance with IFRS 3 occurs anytime the parent company loses control. It sells some of the shares here and retain shares which are now less than 51%, from 50% to 0. In which case we are saying a gain or a loss on disposal should be what? Should be determined. And therefore you can say when disposal of interest occurs, that is when the parent company loses control, control, a gain or loss on disposal should be computed or should be determined, we can say should be determined as follows. So how do we compute that particular gain or loss on disposal of interest? So gain or loss on disposal of interest. So to determine this gain or loss on disposal of interest, number one, we take the fair value of purchase consideration received. So when the parent company sold some of the shares, or basically all the shares in a subsidiary, how much amount was received by the parent company? So that is now what referred as the fair value of purchase consideration received. To this we add the fair value of investment which has been retained. When talk about the fair value of the investment which has been retained, so this basically applies in case of a partial disposal, whereby the parent company has not sold all the shares in a subsidiary. If, for example, the A Limited, which is the parent, which initially had acquired 80% shareholding in B, which is a subsidiary, if, for example, the parent company sells like half of these shares, sells 40% of the shares held here, it means that the parent company has retained a shareholding which is equal to 40%. So at the date the disposal took place, the remaining investment will have to be revalued at its fair value, and always that figure will be provided to you. That's what we refer to as the fair value of the investment retained. So after adding those two figures, we come here and we less, number one, the fair value of net assets, held at date of disposal, So the fair value of the net asset held at the date of disposal, and then to this we also add the parent company unimpaired goodwill. And after deducting those two figures, we can get a positive figure here. If a positive figure, that is a gain, but if a negative figure, this is a loss on disposal a loss on disposal, a loss on disposal. Yes, so this is basically how the gain or loss on disposal is determined anytime the parent company has lost the control. The parent company sells some of the shares held in a subsidiary, and therefore it retains shares which are less than 51%, from 50% to 0. Always in such a case we compute the gain or loss on what? The gain or loss on disposal. So then next we can proceed and look on how we prepare the consolidated financial statement anytime we have changes in the group structure. So let's look on the preparation of group accounts. So in this case, we're going to look on how we prepare the group accounts at different types of disposal. So remember, you have said that disposal of interest can be broadly classified into two: partial disposal and the full what? Disposal. Let's start with the full disposal. The full disposal. A full disposal generally is whereby the parent company sells all the shares held in a subsidiary. Sells all the shares held in a subsidiary. Maybe first of all, you can say that this is a whole what? Disposal, or basically a whole sale of shares in a subsidiary. So a wholesale of shares in a subsidiary company, and this one is basically governed by. This one is governed by IFRS 5. So basically, in terms of how the parent company should treat that particular subsidiary which has been fully disposed, that should be accounted for in accordance with IFRS 5, meaning that that subsidiary now will be termed, or basically will be referred to as a discontinued operation. A discontinued operation, assuming we are told A Limited had acquired 80% shareholding in B Limited, and the parent company sells all these shares. So if that is the case, then this particular subsidiary is a discontinued operation, and should be accounted for in accordance with what? In accordance with IFRS 5. So what IFRS 5 requires is that the parent company should, number one, determine the gain or loss on disposal, and number two, the parent company should determine the gain or loss reported by that discontinued operation, and that one should be recognized, or those two items, the gain or loss on disposal of interest, the profit or loss from the discontinued operation, they should be recognized as separate items in the consolidated income statement. So therefore, we can say in this case, the parent entity or basically company should determine, or in other terms determine, number one, the gain or loss on disposal, the gain or loss on disposal of interest, and number two, the profit or loss from discontinued operation. We can abbreviate this as DO, from discontinued operation. And you are saying that these two items, that is the gain or loss on disposal and the profit or loss from discontinued operation, they should be recognized. This should be recognized as separate line items in consolidated statement of profit or loss should be recognized as separate line items in the consolidated statement of profit or loss. Let's maybe from our group structure here, we introduce another company here, that is C Limited. We also assume that the parent company had a shareholding of 75%. So, and also we are told that the parent company, that is A, had 80% shareholding in B Limited, but we are told during the current financial year, the parent company sold all the shares held in B. So we have said B is a discontinued operation. So therefore, when A Limited is preparing the consolidated income statement, the consolidated income statement or the consolidated statement of profit or loss. So the parent company should first of all determine the profit or loss from the continuing operations. So the continuing operations will be the parent company and the NC, because you have said this one is a discontinued operation. So therefore, the parent company should determine what the profit or the loss from continuing operations. Continuing operations include A and C. And for the parent company to do that, basically, in this case, we take the revenue of this, that is A, plus the revenue of C. And then we also take the expenses, including the cost of sales of A plus that of C, We less that now from the revenue. We get, whatever you get here will be the profit or loss from continuing operations. Continuing operations. And then we are saying that these two items here should be added to the profit or loss from the continuing operations. So then we have the discontinued operations. Discontinued operation, basically, you have said, is this subsidiary which has been disposed. So two items will be included here: the gain or loss on disposal of interest. And you have to recall that this one is computed using that particular approach there, or that particular format there. And then we also have the profit or loss from discontinued operations. So how do we determine this profit or loss from discontinued operations? So we take the revenue of this company. For example, the parent company sold the shares held in B Limited, for example, 6 months from the start of the current financial year. So in that case, you take the revenue of B for the first 6 months and also its expenses for the first 6 months, and then determine the profit or even the loss which was reported by that subsidiary B, which was fully disposed. You'll get the profit or loss from the discontinued operation. So if it's a profit, you add. If it's a loss, we do what? We less here. We less. And then we add that now to the profit or loss from the continuing operations. And then we get the profit for the year. The profit for the year. So that's basically how we deal with what you refer as a full disposal. A full disposal. And basically, remember, these applies in preparation of a consolidated statement of profit or loss. Consolidated statement of profit or loss. So basically, when now preparing the consolidated statement of financial position, at the end of the year, the parent company will have fully disposed its shares in this subsidiary. So the parent company will not be having any control. Equally, there will be no NCI. So therefore, we can say that when preparing this consolidated statement of financial position, we can say there will be no NCI, or basically we can say assets and liabilities of subsidiary fully disposed are not included in consolidated statement of financial position. So the assets and liabilities of that subsidiary will not be included in the consolidated statement of financial position. And equally, as far as that subsidiary is concerned, there will be no NCI. The minority shareholders will not be entitled to share the net asset of that subsidiary as at the end of what? Of there. That's basically how we deal with the what you refer as a full disposal. Then from there we have the other type of disposal. That type of disposal. Recall in our case here we have said that we have two types of disposal: the full disposal and the partial disposal. The partial disposal. Partial disposal. Now here we have different types of partial disposal. Actually, we can say we have different scenarios of partial disposal. Number one or number A, we have what we refer as a disposal of a company which was initially a subsidiary and which still remains a subsidiary. Which still remain what? A subsidiary. A subsidiary company to a subsidiary. So when talk about a subsidiary to a subsidiary, this whereby we can be told the parent company had like 80% shareholding in B Limited, and the parent company, for example, sold 20% of the shares. So if it sold 20% of the shares, then it means that the parent company here retained 60%. Retained 60%. So therefore, you can see B Limited still remain what? Remain a subsidiary. So when it comes to preparing a consolidated income statement, what you do, you take the revenue and expenses of that subsidiary, you add to that of the parent. Actually, that disposal do not have any effect as far as the preparation of the consolidated statement of profit or loss is concerned. On the other hand, when preparing the consolidated statement of financial position, because this company is still a subsidiary at the end of the year, you take its assets and liabilities, you add to those of the parent. Actually, this particular type of partial disposal do not have any effect as far as the preparation of the group account is concerned. It's also important to note that here, because the parent company is not losing control, no gain or loss on disposal of interest is computed. This one is not computed because you have said we only compute that one anytime the parent company loses what? Control. So we can say no gain or loss on disposal of interest. On disposal of interest. Disposal of interest. So that is it about that scenario of partial disposal. So the other type of partial disposal, part B, is a disposal which makes a company which was initially a subsidiary to be an associate or a joint arrangement. So first of all, you have to recall from what you have discussed in our previous sessions that investment in associate, investment in joint arrangement should be accounted for in the same way using the equity method. That is something, first of all, you have to recall, and that's why you can see here we are talking of associate or the joint arrangement at one point. So this whereby we assume that the current financial year was ending on 31st of December 2023. That is the date of consolidation when the group accounts are supposed to be prepared, meaning that the year started on 1st of January 2023. We may be told that the parent company initially had acquired like 80% of the shares, 80% of the shares, like maybe A Limited had initially acquired 80% shareholding in B Limited some time back, but during the current financial year, maybe on 1st of July 2023, the parent company sold or disposed 40% or half of these shares. So mean that the parent company sold 40, and that means that the parent company then retained 40%. Retained 40%. So if it retained 40%, then it means that this company, which was initially a subsidiary, then becomes what? An associate. Becomes an associate. And therefore, in the first 6 months, the parent company, you can see, had 80% shareholding, meaning that this company was therefore a subsidiary. And then after selling half, the parent company retained 40%, meaning that in the last 6 months, that company was what? Was an associate. Was an associate. So how do we go about in this case, or how do we prepare the group account in such type of a partial disposal? Number one, when preparing the consolidated statement of a profit or loss, in preparing the consolidated statement of profit or loss, number one, we have to compute the gain or loss on disposal. We have to compute the gain or loss on disposal of interest, of which this particular gain, if it's a gain, it is recognized as an in the income statement as an income. If it is a loss, it is recognized as an expense. Number two, we then consolidate the results of the subsidiary company up to date of disposal. Up to date of disposal. Like in this case, in preparing the consolidated income statement, we're going to take into account the revenue and expenses of B for the first 6 months when it was a subsidiary. And then in the last 6 months, because it was an associate, you have to recall that we don't include the revenue and expenses of associate in the consolidated income statement. So that's why we are saying consolidate it results up to the date of disposal, and thereafter include group share of its profit after tax, and that is in accordance with equity method. That is in accordance with IS 28, because as far as the associate is concerned, we include, or what we include in the consolidated income statement is the group share or the parent company share of its profit after tax. So mean that you'll take the profit after tax of this company here, which is always given in its income statement, multiply that with 6 all over 12, so that you get now the profit after tax for the last 6 months when it was an associate, and then multiply that with the parent company shareholding in B, which is 40%. So that's basically how we prepare that. And then how do we prepare the consolidated statement of financial position? Consolidated statement of financial position. So in preparing the consolidated statement of financial position, our interest is basically the status of this company at the end of the year. So what will be the status of the investee company at the end of the year? At the end of the year, the investee company, that is B, will be an associate, and therefore in accordance with the equity method, what we include in the consolidated statement of financial position as far as the associate is concerned is something called the investment in associate. We don't include, or we don't combine the asset and liabilities of the parent, those of the associate, in preparing the consolidated statement of financial position. So therefore, in preparing this, we say compute the investment in associate, investment in associate or joint arrangement, and included in consolidated statement of financial position as a non-current asset. So in that case, you compute, or we compute something called the investment in associate or investment in joint arrangement, and we include that in the consolidated statement of a financial position as a non-current asset. So how do we compute this particular investment in associate or joint arrangement? So investment in associate or joint arrangement. So this one is computed using this approach here, or this format. So number one, we take the fair value of investment which has been retained. Fair value of investment retained. So the investment which has been retained here is 40%. And basically we have said that in case of a partial disposal, the investment which has been retained always will have to be revalued to its fair value on the date of disposal. That figure will always be provided to you. So you'll be told that the investment which has been retained on the date of disposal had this fair value. That's what you use here. And then to this we add the group share of post-acquisition net assets. Post-acquisition net assets. And whatever you get here is now what you refer to as the investment in associate, investment in joint arrangement, and you're saying that that should be taken to the consolidated statement of financial position as one of the item of the non-current asset. Yes. So basically those are different scenarios of partial disposal, and basically how we deal with them specifically in preparing the consolidated financial statement. So basically that's what you need to know. I want us to stop at that particular point. Once we come back in our next session, I want us to look on an illustration question regarding how to prepare the group accounts, and also how to compute the gain or loss on disposal in case of disposal of interest. So see you in the next session.
Greetings to you all and welcome back to the lesson. Today we are continuing with the subject strategic management. We've been studying business strategies and models. We've covered the generic competitive strategies. Today we move to the interactive strategies. Now in studying interactive strategies, we are going to consider the interactive price and quality strategies. Then there is the cooperative strategy and the game theory. But first of all, what do we mean by interactive strategies? Interactive, from the word interact, to interact. Interactive strategies refer to a competitive framework where a firm's strategic choices are made based on the anticipated actions and reactions of other market players. This is unlike the generic strategies which focus on internal positioning.
Hi candidates, welcome to another session of Manifested Online Classes. In this session, I want us to look on an illustration question regarding how to prepare the group accounts, whereby we have a disposal of interest. And the illustration I want us to go through reads, Pareto Limited is a holding company of a listed group of companies with its year ended on 30th of June 2021. So Pareto Limited has made a number of acquisition and a disposal of investment. So the following summarized draft statement of financial position relate to the group companies for the year which ended 30th of June 2021. So we are given the statement of financial position for three companies: Pareto, Paba, and also Dafu Limited. Non-current assets include property, plant, and equipment. Then we have investment in Paba, investment in Dafu. We have financial assets, and then we have the current assets. We have the total assets. At the equity, we have ordinary share capital, share premium, retained earnings, and then we have non-current liabilities and current liabilities. Then we have some additional information. Number one, where we are told on 1st of October 2020, Pareto Limited acquired an 80% equity interest in Paba Limited when its retained earnings stood at 3,500 million. The purchase consideration comprised of 1,250 million of Pareto Limited shares with a nominal value of shillings 1 each and a market price of 6.8 each. At the acquisition of Paba Limited, the only adjustment required for to the identifiable net asset of Paba was for land which had a carrying amount of 625 million, less than its fair value. So number two, we are told the group policy is to measure non-controlling interest at fair value. That information definitely is to guide you how to compute the goodwill. If you come across that information that the group policy is to measure NCI at fair value, it means that when computing the goodwill, we then compute that goodwill using the full goodwill method. And then you're told at the date of acquisition of Paba Limited, the non-controlling interest had a fair value of 21.25 million. Number three, Pareto Limited had acquired 100% equity interest in Darfur a number of years ago when it retained earnings amounted to 1750 million. At acquisition, the fair value of identifiable net asset of Darfur approximated their carrying values. The purchase consideration comprised cash amounting to shillings 5750 million. Number four, you're told Pareto Limited disposed of 60% of its investment in Darfur on 1st of April 2021 for shillings 4,700 million, when the fair value of identifiable net asset of Darfur were shillings 6250 million. The fair value of the remaining 40% equity interest was 4,300 million at disposal. Pareto Limited has not accounted for the disposal. And then number five, you're told none of the companies had issued any shares since Pareto Limited acquired its shareholding in them. And number six, you are told neither the goodwill on acquisition of subsidiaries nor investment in associate, that is, had been impaired. So from that information, what you're required to do, number one, is we compute the goodwill arising on acquisition of the investment in the subsidiaries. Number two, to compute the gain or loss arising on disposal of the investment in Darfur as reported, Roman 1, the individual financial statement of Pareto, Roman 2, consolidated statement of profit or loss, and finally part C of that question we are required to prepare the consolidated statement of financial position as at 30th of June 2021. So these are questions for group account, and as usual what we need to do first of all is to come up with a group structure. Then we go through the additional information, we see whether there are workings which we need to do, and then from there we prepare, or basically we compute what is required. So therefore, let's first of all we come up with the group structure here, which will be working one, group structure, group structure. So where do we get that particular information about the group structure? So that information, we have it from the additional information number one, whereby we are told on 1st of October 2020, Pareto Limited acquired 80% equity interest in the company which is called Paba Limited on 1st of October 2020. 1st of October 2020, and also we are given the retained earnings of Paba on that date. That one will be used in the computation of goodwill, including the purchase consideration. That one will be used in the computation of goodwill. But let first of all we go to the additional information number 3, whereby we are told Paba Limited, not Paba but rather Pareto, Pareto Limited had acquired 100% equity interest, 100% equity interest in the company which is called Darfur Limited a number of years ago. So in this case, we are not given the specific date of acquisition, but we are told Pareto Pareto Limited had acquired 100% shareholding in Darfur some time back, or basically a number of years ago. So basically what that means is that from this group structure here, Pareto Limited, this will be the parent company, and automatically the parent company is the one which is supposed to prepare the group account. Then PABA is a subsidiary, and also Darfur here is a fully owned subsidiary, a fully owned. Fully owned means that the parent company acquired all the shares or hold all the shares in that particular subsidiary. So we have that information, but also before we go maybe back to note number 1, there is another information which they are given and which is very, very important in note number 4, sorry, where we are told Pareto Limited disposed of 60% of its investment in Darfur on 1st of April 2021. So that is the information about disposal of interest. Disposal of interest. Disposal of interest, whereby we are told Pareto Limited disposed 60% shareholding in what? In Darfur. So we have disposal of interest in Darfur Limited. So, and automatically this particular disposal of interest, this usually take place during the current financial year. Now, first of all, if we go to the information we have at the paragraph 3 up there, so the current financial year was all ended on 31st of or that is June 2021. So basically what that means is that this year started on 1st of July 2020. But now if we go back to the information we have in note number 4, we are told Pareto Limited disposed 60% of its investment in Darfur during the current year. So that is the 1st of April 2021. 1st of April 2021. So how many months do we have here to the date of consolidation? We have April, May, June. So here we have 3 months, and automatically here we have what? 9 months. So what that means is that for the first 6 months, this particular company here, that is Darfur, this was a subsidiary, because you can see in the first 9 months, the parent company had 100% shareholding. But on this date, we are told the parent company disposed 60% of its shareholding in Darfur. So that what that means is that the parent company retained 40% shareholding in Darfur, and therefore Darfur in the last 3 months was an associate. And therefore, if for example in this particular question here the examiner was requiring the candidate to prepare the consolidated income statement, it's very, very important to note that this company here, that is Darfur, for the first 9 months you treat it as a subsidiary, meaning that you take into account its revenue and expenses for the first 9 months, for the first 9 months, and then you add that to the revenue and expenses of the parent and the revenue and expenses of what? Of PABA. But in the last 3 months, that is, Darfur Limited will be an associate, and therefore what you need to include in the consolidated income statement is the parent company share of Darfur Limited profit after tax in the last 3 months. And also in this case, because the parent company lost the control, you have to determine the gain or loss on disposal, which then you recognize in the income statement as part of the profit or loss. But in our case, if you check on what the examiner was requiring here, specifically in part C, we are only required to prepare the consolidated statement of profit, the consolidated statement of financial position. So what that means is that in preparing that, we check the status, we determine the status of Darfur at the end of the year. Darfur Limited at the end of the year will be an associate, and therefore in preparing the consolidated statement of financial position, we are going to add similar items of asset and liabilities, those of Pareto, the parent, and those of PABA, but we are not going to take into account the asset and liabilities of Darfur because it's an associate. So what we are going to do is we are going to determine something called the investment in associate. And basically, that is the only item we are going to include in the consolidated statement of financial position as far as Darfur Limited is concerned. Yes, that is why the group structure here is important. But before you do that, maybe you can just go through this additional information again. We see whether there are some workings which are required. Note number 1, we go back to note number 1. We are given information about the acquisition of PABA, and actually the retained earnings, the purchase consideration, all that will be used in the computation of goodwill, which you are required to compute as per part 1 of that question. And also we are told that at the date of acquisition, PABA Limited, or at the acquisition of PABA, the only adjustment required to the identifiable net asset of PABA was a LAD with a carrying value of 625 million less than the fair value. So basically what that means is that this company on the date of acquisition devalued the asset, and remember that process we refer to it as the fair value adjustment or the fair value exercise. So this is by PABA Limited, and the asset it revalued was LAD, and we are told that this LAD had a carrying amount of its carrying amount was 625 million less than the fair value. So in this case, the carrying amount was less than the fair value with an amount of 625 million. In other terms, we can say that the fair value, we start with the fair value, was greater or was more than the carrying amount with 625. So automatically, what is this? This is a revaluation gain. And this particular revaluation gain, which occurred on the date of acquisition, automatically was not accounted for by PABA. So therefore, in preparing the consolidated statement of financial position, this one we added to the group PP, and number 2, this one we treat it as a pre-acquisition revaluation reserve, pre-acquisition revaluation reserve. In computing the goodwill on acquisition, that will be one of the component of the net worth asset of PABA Limited. So I think we have that particular information there. And then it is also important to note that this particular asset here, that is LAD, this is not a depreciable asset. LAD is not depreciated, and therefore in this case, no depreciation other charge. No depreciation other charge to be computed here, simply because LAD is not depreciable asset. But if this was a depreciable asset, we needed to compute the depreciation other charge. So let's move to, but we will still come back to that particular point, specifically in answering part A of that question when computing the goodwill. So in number 2 is about information regarding the computation of goodwill. We will still use that in answering part A. And then part additional information number 3, we are given information about the acquisition of Pareto, where we are told the parent company, that is the acquisition of Darfur, whereby we are told Pareto Limited had acquired 100% shareholding in Darfur some time back. We are given it retained earnings there, and also the fair value of identifiable assets, which we are told equaled to the carrying amount. So mean that at the date of acquisition, this company revalued the asset, and the fair value of identifiable asset was equal to carrying amount. There was no revaluation gain or loss. And then you're given the purchase consideration, which was 5750. All that information, we're going to use it in answering part A, specifically in computing the goodwill. And then we're given information number 4 about the disposal of some disposal of interest in Darfur. And also this one, we're going to use it in answering part B of that particular question. And then we have note 5. Note 6. I think no working which is required here. So I think we can go straight to part A of that particular question. Part A of the question. So what you are required to do is to compute the goodwill arising on acquisition of investment in subsidiaries. Investment in subsidiaries. So we start by computing the goodwill arising on acquisition of the first subsidiary here, that is PABA. So let's start by computing the goodwill arising on acquisition of investment in PABA Limited. PABA Limited. Equally, remember, as per the information which is given in note number 2, we are computing the goodwill using the full goodwill method. That's the first thing you need to appreciate, or basically to note. So how do we compute the goodwill using the full goodwill method? Number 1, we take the cost of investment. The cost of investment. So how much purchase consideration was paid by the parent company in acquiring the shares of PABA? So that information, we have it in the balance sheet or in the statement of financial position of Pareto, specifically under the non-current asset. We are given the amount of the amount invested by Pareto in PABA, which is 8,500. 8,500. So to this, then we add the NCI at fair value, because you're using the full goodwill method. So this figure is also given in note number 2. Additional information number 2, the last sentence, we are told at the date of acquisition of PABA, the non-controlling interest had a fair value of 21.25. So we add the 2. So this will give us 25, 10, 6, 10, 6. So let's confirm whether that is correct. So we have 85 plus 21.25, so which will give us 10,625. That is correct. So then from there we proceed and we less fair value of net assets, fair value of net assets acquired. So how do we compute this one? Because it's not given, so we have to determine the fair value of a net asset of PABA on the date it was acquired, and we determine that by taking the ordinary share capital of PABA plus pre-acquisition reserves. Pre-acquisition reserves. So therefore, where do we get this? Let's go back to the statement of financial position of PABA, specifically under equity. Under equity. So under equity, number 1, we are given the ordinary share capital of PABA. The ordinary share capital of PABA is a figure of 25. Still, in that case, we also have a share premium. Share premium of a subsidiary company, unless told otherwise, is always taken to be a pre-acquisition. Then the retained earnings, which we have there of 5250, that is at the end of the current year. That is not what we're interested with. We're interested with the retained earnings of PABA on the date it was acquired. And that is now what we refer as the pre-acquisition retained earnings. So that one is given in the additional information number 1, whereby we are told when PABA Limited was acquired, its retained earnings stood at 35. Stood at 35. And then to this, other than taking now the items in the statement of financial position, specifically under equity, you also have to check whether this company revalued its asset on the date of acquisition. In case it revalued its asset, was there a revaluation gain or loss? So like in our case, remember here, PABA Limited revalued land with an amount of what? 625. This one we have said is a pre-acquisition revaluation reserve. A pre-acquisition revaluation reserve, which is 625. 625. Yes, I think that's what we have. And basically what we need to do here, we get now the total. So we have 25 plus 1,000 plus 35 plus 625. So this will give us 7625. And because we are using the full goodwill method, we take 100% of this. 100% of this will be 62. That is 7625. We less it from the figure up there. We less it from 10,625, which will give us goodwill on acquisition of what? Over 3,000. So that is the goodwill on acquisition. And remember that is a full goodwill. Basically the goodwill determined using the full goodwill the full goodwill method. So basically that is what is required there, and basically the items which are marked in such a case are those items which we have there. Then we need to proceed and compute the goodwill on acquisition of the other subsidiary, that is the full goodwill on acquisition of goodwill on acquisition of Dafu Limited. Dafu Limited. So we need to have two columns here, and even before you compute now the goodwill on acquisition of Dafu, it is very, very important for you to note that in Dafu there is no NCI here. There is no NCI because you can see that the parent company acquired all the shares, acquired 100% of the shares issued by what? By Dafu. So therefore in Dafu we don't have what? NCI. And that's why you can see, despite the group using the partial goodwill method, the full goodwill method in computation of goodwill, we are not given the NCI at fair value in Dafu, simply because there is no NCI. So therefore what we do here, we take the cost of investment, the purchase consideration paid by the parent company, that is Pareto, in acquiring shares of Dafu. That one is given in the statement of financial position of Pareto under the non-current asset, which is 750, and then in this case we should add the NCI at fair value, which you are saying is 0 because we don't have NCI. We don't have NCI. We get 5750, and then to this we proceed with less fair value of net assets acquired. Equally, to compute this, we take the ordinary share capital of Dafu plus pre-acquisition reserves plus the reserves it was having on the date it was acquired. So where do we get that? Let's first of all we go to the statement of financial position of Dafu, specifically at the equity section. So the ordinary share capital of Dafu is 2,000. Also Dafu had a share premium of 500 or 500, and then the retained earnings in the statement of financial position of Dafu 5750 is at the end of the current year, but that is not what we're interested with. We're interested with the retained earnings of Dafu on the date it was acquired, and that is given in the additional information number 3. Pareto Limited acquired 100% equity interest in Dafu a number of years ago when it retained earnings. Earnings stood at 1750, and also you check whether Dafu Limited revalued its assets. So basically, as per the information which are given in note number 3, this company revalued its asset, but you're told their fair value was the same with the carrying amount. There was no revaluation gain or loss. So what we do, we get the total here, and then we less that from the figure we have down there. So we have 2,000, which will give us 2,500 plus 1,750. So which will give us 4,250, and then we take 100% of this. 4,250. We less it from this figure minus 5750. 5750, which now will give us a goodwill of that, which will give us goodwill of 1,500. So basically that also what was required there, and automatically the items to be marked there include what we have there, that, and that. And basically by computing the goodwill on acquisition of the two subsidiaries, the marks allocated there were 4. So let's move to part B of that particular question. Part B, we are required to compute the gain or the loss on disposal of investment in Darfur Limited, Roman 1, as it was reported in the individual financial statement of Pareto, as it was reported in the individual financial statement of Pareto. Now, in this case, when Pareto Limited basically invests, or the parent company invests in a subsidiary, to the parent company, that investment in a subsidiary is like an asset. And therefore, once the parent company sells some of the shares, or basically all the shares in a subsidiary, the parent company in its individual financial statement, not in the group account, in its individual financial statement, it will need to recognize the gain or the loss on disposal. Now, that gain or loss on disposal is computed by taking the sales proceeds. The sales proceeds is basically the amount of money which was received by the parent company after selling some of the shares or all the shares in the subsidiary, minus the carrying amount of investment disposed. Investment disposed, or basically investment sold. And this one is very simple because all these figures are given. So let's go to the additional information number 4, and you're told Pareto Limited disposed 60% investment in Darfur on 1st of April 2021 for 4,700. So that 4,700 is the sales proceeds, the amount of money received. Yes, and then to this, what we know is that the amount of money which Pareto Limited had invested in Darfur is 5750, which is given in the balance sheet of Pareto. The amount invested in Darfur was 5750. In the statement of financial position of Pareto and current asset, the amount invested in Darfur 5750. But in our case, we know the parent company only disposed 60% of that. So that is the carrying amount of the investment sold. So that's how we compute the gain or loss to be recognized in the individual financial statement of Pareto. So this will give us what? 60%, 5750. We less that from 4,700. So this will give us 12 what? 1200. 1200, and basically that is a gain. That is what? That is a gain. That is a gain. So basically by doing that, the candidates here were allocated how many marks? Were allocated 2 marks. 2 marks for computing that. You can see that was quite straightforward. Also, in part B, we are required to compute the gain or loss to be or as it will appear in the group account, as it will appear in the consolidated statement of profit or loss. So this is now the gain or loss to be recognized in the group account. So this is something we discussed in our previous session, how to compute the gain or loss arising from disposal of interest. So in terms of how we compute this, we take a number of figures here. Number 1, we take the fair value of consideration which was received. How much amount did the parent company receive after selling the 60% stake or interest in Darfur? So that figure, we already have it in note number, additional information number 4, and which was 47. And then to this, we add the fair value of investment retained. Fair value of investment which was retained. Still, we have that in note number 4 as a figure of 4,300. The fair value of the 40% equity interest which was retained was 43. After adding those two figures, we proceed and we less 2 items. Number 1, we less the parent company unimpaired goodwill. Parent company unimpaired goodwill, and that is something we have already computed here. the goodwill arising on acquisition of Darfur, this figure here. And we also have to note that this particular goodwill here, despite computing it using the full goodwill method, this is a goodwill attributable to the parent company, because in this Darfur we don't have NCI, because generally here what we take into account is the parent company goodwill, which is not yet impaired. So this goodwill was not impaired as per the information given in note number 6, and the full amount is the goodwill attributable to the parent company. So that is what we list here. And then we also list the fair value of net assets at date of disposal. At date of disposal. So what was the fair value of the full limited net asset on the date of disposal? That information, we also have it in note number 4. We are told on 1st of April 2021, the fair value of identifiable net asset of Darfur was 6250. Was 6250. So that's how we determine the gain or loss on disposal to appear in the consolidated, or to be recognized in the consolidated statement of profit or loss. So we have 47 plus 4700 plus 4300 minus 15 minus 6250. Is that will give us 1250, which is a positive figure, and that is a gain on disposal. The gain on disposal. The gain on disposal. And actually, that what was required in that part there, and basically by doing this, the marks allocated there were 2. So these are the items automatically which were marked. So let's move to part C of that particular question, whereby we are required to prepare now the consolidated statement of financial position, which you have said is simple, because what we need to do is to appreciate the fact that this will be a subsidiary at the end of the year, and then Darfur Limited at the end of the year, it will be an associate. It will be an associate. So therefore, in preparing a consolidated statement of financial position, we combine similar items of asset and liabilities, those of the parent and those of the subsidiary. And then for Darfur, we just compute something called the investment in what? In associate. So therefore, let's do that. Part C. So the name of the group here will be is a Pareto group. This is a consolidated statement of financial position as at 30th of June 2021. 30th of June 2021. So here we just need to have a single column, and our figures are in thousands of shillings, in million of shillings. So we start with the non-current assets. So first of all, we have the PPE. So of PPE, we are taking the PPE of the parent, recall that, of the parent, that of PABA. We are not including those of Darfur. Darfur is an associate. We don't consolidate asset and liabilities of an associate with those of the parent. What we include here, as far as the associate is concerned, is something called the investment in associate. So therefore, we are only adding the PPE of Pareto and those of PABA. We have 14,900 plus 9250, and then we check whether we have any consolidation adjustment affecting the PP. Do we have any consolidation adjustment? Yes, this one. On the date of acquisition, PABA Limited revalued its asset upward with an amount of 625, which was not accounted for. So we add that here, 625. So remember, we don't have any depreciation other charge, which would have been deducted there. So then below the PP, we'd have investment in PABA, investment in Darfur. So those investment, we don't include them here, but as far as PABA Limited is concerned, which will be a subsidiary at the end of the year, we include its goodwill here. So the goodwill on acquisition of PABA is 3,000. And then for Darfur at the end of the year, remember, it will be an associate. So what we include here as far as the associate is concerned is investment in associate or investment in Darfur Limited. So in our previous session, we looked on how to compute this, and actually we said to compute investment in associate, we take the investment, that is, we take the fair value of the investment which has been retained. So which is what you are given here, 43. And then to this, what we add is the group share of the post-acquisition net asset in that DAFU. So how do we get the group share or the parent company share of the post-acquisition net asset in DAFU? So what we do is that we take the net asset of DAFU at the end of the year, and basically by now we know that the net asset of a subsidiary is always equal to equity, share capital and reserves. So what is the equity of DAFU at the end of the year from its statement of financial position? You can either take the asset minus liabilities, or you just take equity. The total equity of DAFU, which is the same with the net assets, is 8250. This is the net asset of DAFU at the end. But now the date DAFU Limited became a subsidiary, became an associate, sorry, its net asset, you have to recall in note number 4, we were given as a figure of 6250. So therefore, whatever the difference here is the post-acquisition net assets. So we get the parent company share of this, which will be 40%. Which will be 40%. So this will give us a difference of 2,000, 40% of 2,000, 40% of 2,000. This one is 800. We add it to this, which will give us 5,100. So that is now the investment in what? Investment in DAFU, which you are saying will be included here as an item of non-current asset. Okay, so then below that we also have the financial assets. Financial asset, no adjustment for this. We just take the financial asset of the parent, 31, plus those of the subsidiary, 28. This will give us 59. And then from there we have the current asset. Actually, for current asset, we are given the total, 3850 plus 4425. Do we have any adjustment to the current asset? We check for things for like intercompany debts. We don't have things like unreleased profit. We don't have. So means that no adjustment for this. So what we just need to do, we get the final figure. We get the final figure. We have 3850 plus 4425, which will give us 8275. We get the total assets. The total assets. So let's first of all we compute the figure for PP there. We have 14,900. There is something we have forgotten here before we add here. So this particular purchase consideration which was received, that is a figure for 47. This amount was not yet accounted for. So therefore is amount receivable. It was not yet paid. So we also include it as part of the current asset. We also include it as part of the current what? Asset before we get the final figure there for PP. So let's add 47, 82. 75, 8275 plus the purchase consideration received, this one, which will give us 12,975. Okay, so we get the final figure for PP. We have 49 plus 9250 plus 625. Which will give us 24, that is 24,775. Yes, and then we can add all these figures now, plus 3,000 plus 51 plus 59 plus 12,975. So that will give us a total of 51,750. So these are total assets. So we proceed, record equity. So for equity, we record the ordinary share capital, that of the parent company only, which is the 10,000. The share premium for the parent company only. For the parent company only, 5,000. Then from there, we will compute the group retained earnings. This one we computed as the last item. And then we will get the total equity. Total equity, we proceed and compute the non-controlling interest. And the non-controlling interest here will only be computed as far as or in relation to, or we are going to compute this for PABA. PABA is the one which was a subsidiary. Remember, DAFU is an associate. So then from there we have non-current liabilities. So for non-current liabilities, we are given the total. So we have 85 for the parent, and that for PABA, no adjustment here. So we get a total of 14.5. And then we have the current liabilities. Current liabilities, we have 47.75 plus what? Plus 17.25. We don't have any adjustment there. We get total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So let first of all we add these particular figures here. For current liabilities, we have 47.75 plus 17.25, which will give us 65. And then for the non-controlling interest, this one we can compute it directly because the group policy here is to measure NCI at fair value. So when that is the case, then the computation of NCI is quite simple, because what we do, we take the NCI at fair value on the date of acquisition, which is 21.25, plus now the group share. The group share of what? The group share of post-acquisition adjusted retained earnings. So the retained earnings of PABA Limited after it was acquired, how do we get that? We take its retained earnings at the end of the year. The retained earnings of PABA at the end of the year in the statement of financial position is 50.
Hello and welcome to the lesson. The subject is business and data analytics. Today we are going to study the various types of data analytics. By the end of this lesson, you should be able to explain at least 3 types of data analytics. Types of data analytics. Types of data analytics. Data analytics, learners, is a broad field, and there are 4 main types of data analytics. There are 4 main types of data analytics. Number 1 is known as descriptive analytics. Number 2, diagnostic analytics. 3, predictive analytics. 4, prescriptive analytics. 4 types. Descriptive analytics, diagnostic analytics, predictive analytics, and prescriptive analytics. Now, each type here has a different goal and a different place in the data analytics process. Descriptive analytics is the first one. Descriptive analytics helps answer questions about what happened. Answer questions about what happened. What happened. And the techniques here summarize large data sets to describe outcomes to the stakeholders. And by developing the key performance indicators, all right, the strategies can help track successes or failures. And we may also have specialized metrics that are help to track the successes or the failures in an industry. We could have metrics such as return on investment, which is used in many industries, and so on. So the process here requires the collection of relevant data. Here it requires the collection of the relevant data, the processing of the data, data analysis, as well as data visualization. And the process here provides essential insight into the past performance, because data analytics answers the question, what happened? It looks into the past, the history, what happened in the past, what is the past performance, and so on. So descriptive analytics looks into the history, into the past, what happened. The second type of data analytics is diagnostic analytics. And here, diagnostic analytics helps answer the questions about why things happened. Why things happened. This is what happened. Diagnostic answers the question, why things happened. And the techniques here supplement more basic descriptive analytics. They take the findings from the descriptive analysis and digs deeper into the cause of what happened. And the performance indicators are further investigated to discover why they got better, why things got better, why things got worse, and so on. And there are various steps in the diagnostic analytics. The first step being the identification of anomalies in the data. And the anomalies may be the unexpected changes in a metric or a particular market. The second step in the diagnostic analytics is the collection of relevant data. Collection of relevant or related data. This is data that is related to the anomalies. Okay? So first of all, I've said the first step in the diagnostic analytics is to identify anomalies in the data. Then number two, data that is related to the anomalies is collected. Identify anomalies in the data, then collect data related to the anomalies in the data. Then after that, statistical techniques are used to find relationships, to find trends that explain the anomalies. That is diagnostic analytics. I repeat, identify anomalies, step number one. Step number two, collect data related to the anomalies. Then number three, use statistical techniques to find relationships, to find trends that explain the anomalies or the cause of the anomalies. Let me put that down. One, identify anomalies in the data. Two, collect data related to anomalies. Three, use techniques to do what? To identify or to find relationships, to find trends that explain the anomalies. Use mathematical or statistical techniques to find relationships and trends in the anomalies. The third type of data analytics is predictive analytics. Predictive analytics, on the other hand, helps answer the question, what will happen in the future? Predictive analytics helps answer the question, what will happen in the future? And the techniques, the techniques here use historical data to identify trends, then determine if they are likely to recur. The predictive analytical tools provide valuable insight into what may happen in the future, and its techniques include variety of statistical as well as the machine learning techniques, such as the neural networks, the decision trees, the regression, and so on. So based on historical data, the predictive analytical tools can help the firm answer the question, what will happen in the future, by looking at trends in the historical data, the past performance, predictive analytics from the word predict. These tools may help a company to answer the question, what will happen in the future? Tools such as regression, machine learning, and so on. Do you understand? Yeah, that is pretty clear. Predictive analytics. Then the last type of data analytics is prescriptive analytics. Prescriptive analytics helps answer the questions about what should be done. What should be done? What should be done? Prescriptive analysis helps answer the questions about what should be done. What should be done. And by using insights from the predictive analytics, data-driven decisions can be made. Data-driven decisions can be made based on predictive analytics. Data-driven decisions can be made, and that allows businesses to make informed decisions in face of uncertainty. And candidates, prescriptive analytics techniques rely on machine learning strategies that can find patterns in large data sets. And by analyzing past decisions, by analyzing past events, the likelihood of different outcomes can be estimated. All right? Prescriptive analytics help answer the question, what should be done? This type of data analytics provide insights about insights that businesses need to make effective and efficient decisions. They provide insight that businesses need to make effective and efficient decisions. So these are 4 types of data analytics. We've said data analytics is a broad field. We've briefly described 4 types of data analytics. The first one being descriptive analytics, which we've said answers the question, what happened? Diagnostic analytics answers the question, why things happened. Number 3, predictive analytics answers the question, what will happen in the future. And lastly, prescriptive analytics helps answer the question, what should be done about what should be done by using insights from predictive analytics. You've said also that data-driven decisions can be made. Data-driven decisions, because the decisions are based on past data, on past big data. So these are 4 types of data analytics: descriptive analytics, diagnostic analytics, predictive analytics, prescriptive analytics. Here is your today's assignment. Explain 4 types of data analytics, and when doing the assignment, make sure your notes You don't make reference to notes, you don't make reference to videos. Try and see if you can recall what you have learned from your memory. Thank you. Bye-bye. Greetings to you all and welcome to the lesson. The subject is business and data analytics. We've been studying the first topic, Introduction to Data Analytics. So far, we've done the CRISP, which is an acronym for the Cross-Industry Standard Processing for Data Mining Framework. Under that subtopic, we discussed the data concepts, the conceptual concept, logical concept, physical, and also physical data models. We went through the stages in data life cycle. Then in the second subtopic, we've begun looking at big data and data analytics. We, in our last lesson, defined big data. In our today's session, we're going to describe the 5 V's of big data. The 5 V's of big data. And to remind you, candidates, big data, as the name suggests, is data that is very large. Big data is defined as very large data sets having large, varied, and complex structure, with difficulties of storing, analyzing, and visualizing for further processes or results. So big data is a combination of the unstructured data, the semi-structured data, and the structured data. All right? Big data is a combination of data that is unstructured, semi-structured, and structured. Unstructured, semi-structured, and structured. Do you understand? And big data can be mined to gain insights, leading to predictive modeling and other advanced analytics applications. Big data can also be used to improve operations. Big data can be used to provide customer service. Big data can be used to create personalized marketing campaigns. And all that increases value. Okay? And as an example, big data can provide companies with valuable insights into their customers that can then be used to refine marketing techniques to increase customer engagement and conversion rates. And organizations that use big data have a potential competitive advantage over those that don't have, since they make faster and more informed business decisions as provided by the data. So in our today's lesson, we are going to describe the 5 V's of big data. So by the end of the lesson, you should be able to describe the 5 V's of big data. And these V's also help us to understand characteristics of big data. The V's are: 1, volume; 2, variety; 3, velocity; 4, veracity; 5,
value, 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 value. 5 V's. 1 V, 2, 3, 4, 5. 5 V's. The first one is volume. Volume. Volume refers to the quantity of data. Volume refers to the quantity of data. It refers to the amount of data that exists. And volume is like the base of big data, as it is the initial size and amount of data that a company can collect. And if the volume is large enough, it can be considered big data. But we know what is considered to be big data is relative. What is big data to company A may be small data to company B. And may also change depending on the available computing power that is on the market. So volume refers to the quantity of data. Number 2, variety. Variety. Variety, on the other hand, refers to data types. Types refers to data types. Because we have diverse types of data, we have diversity of data types. An organization may obtain data from a number of different data sources, which may vary in value. Data can be obtained from outside an enterprise, or data can be obtained from within the enterprise. We saw earlier we have unstructured data, which we know is data that is unorganized and comes in different files or formats, such as texts, audio data, we have video format, log files, and so on. We have data that is semi-structured. This is data that may not have been properly organized into specialized repository, but it may have associated information. And it makes it easier to process it as compared to the unstructured data. But structured data, meanwhile, is data that has been organized into formatted repository, meaning that such data is made more addressable for effective data processing and analysis. So there are various data types depending on data that is received from different sources. Data may be in form of text, it may be verbal, it may be written, it may be in video format, data may be in audio format, data may be obtained from without the organization, data can be obtained from within the organization. So this is a characteristic of big data. And I've said data that is structured is easier to process and analyze such data as compared to data that is unstructured. Then thirdly, we have velocity as the third V of big data. Velocity. Now, velocity refers to the time that is taken to process and analyze data. It refers to how quickly data is generated and how quickly data moves from point A to point B. And velocity is an important aspect for companies that need data to move quickly. There may be need to have quick data flow so that such data is available at the right time to make the best business decisions possible.
And an organization that uses big data will have large and continuous flow of data that is being created and sent to different destinations. All right? Big data being generated quickly. Big data being processed quickly or sent to different destinations for processing. And we say that data could flow from sources such as machines, such as networks, such as smartphones. Data can flow from sources such as social media. And such data needs to be digested and analyzed quickly. And at times, such data ought to be analyzed real time. And I can also say that it may be better to have limited set of collected data than to collect more data that an organization can handle. Why? Because that can lead to slower data velocities. For what is the point of having big data that is not analyzed or that is not processed? So it's rather you have a limited amount of data that can be processed, that can be digested, that can be quickly analyzed, if possible real time, because at times information may be required, decisions may be required to be made real time. Therefore, data has to be made available for making such decisions. Velocity refers to how quickly data is generated and how quickly data is moved or flows from point A to point B. The fourth V is veracity. Veracity. Veracity refers to the accuracy of data. The accuracy of data. The correctness of data. The quality of data that is gathered. So gathered data could have sometimes missing pieces. Data gathered could also be inaccurate. And it may also not be able to provide real valuable insight. So veracity refers to the level of trust that a leader has in the collected data. Because sometimes data can be messy. Data can be messy, data can be difficult to use. And large amount of data can cause more confusion than insights. Especially if such data is not complete. So veracity refers to accuracy, refers to the quality, refers to the trust that the leader has in the information that is gathered. The correctness of data. So data that has missing, that is not accurate, that is data that cannot be relied upon in making decisions. So veracity is a very important feature of big data. Then we have value. Value. Value refers to the value that big data can provide, the added value that big data can provide, and it relates directly to what organizations can do with the collected data. Because big data is only relevant or important if it adds value. being able to pull value from big data is a requirement. As the value of big data increases significantly depending on the insights that can be gained from them. So it's not enough to have big data. It's not enough to just gather data and have data. The question is such data valuable to the organization? And organizations can use the same big data tools to gather and analyze the data, but how they derive value from that data should be unique to them. All right? So here data refers to the quality of data. The value, this we said refers to the quality of data. This is value added. Veracity refers to the quality of data. The quality of data. The accuracy of data. So, candidates, these are the 5 V's of big data. 5 V's of big data. The first V, volume. Volume. The second V, variety. The third V, velocity. The fourth V, veracity. Then lastly, value. We've said volume refers to the quantity, the amount of data. Variety refers to the data types, which could be unstructured, semi-structured, or structured. We say that data comes in different types, could be in different formats: audio format, text format, video format, log files, and so on. Velocity refers to the time that the organization takes to generate big data and to process or analyze big data. Veracity, on the other hand, refers to the accuracy or quality of big data. Veracity. Then lastly, value, which we've said refers to the value that big data can provide. We've said that it relates directly to what organizations can do with the data that is collected. We said collecting data is not enough. What is important is what value do you derive from the data that has been collected? And that brings the lesson to an end. The objective of this lesson was that by the end of this lesson, you, the learner, should be able to describe the 5 V's of big data, and that will form the basis of our today's assignment. Describe the 5 V's of big data. Thank you for attending this lesson. I hope to meet you in our next lesson. We'll continue to share knowledge in business and data analytics. Thank you. God bless you. Bye.
Greetings, candidates. Welcome to the study of the subject leadership and management. And in my hand, I have the KASNEB syllabus that was released in 2021 KASNEB revised syllabus for paper number 13, leadership and management. This paper was renamed from strategy, governance and ethics. And in our today's lesson, I'm going to do an adumbration of this subject. The unit description is as follows. The syllabus reads that this paper is intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to apply and demonstrate leadership, and management skills to grow an enterprise under various circumstances and environments, including under uncertainties. That is the main objective of studying leadership and management. It is to equip the candidate with knowledge, skills, and attitudes that will go a long way to enable the candidate apply and demonstrate leadership and management skills in order to grow an enterprise under various circumstances, various environments, including uncertain environments. The syllabus also lists 5 learning outcomes. A candidate who passes this paper should be able to, number 1, demonstrate an understanding of leadership techniques and management principles. Leadership techniques and management principles. Number 2, apply knowledge of leadership and management theories in organizations. Number 3, effectively undertake management functions. Number 4, make rational management decisions in an organizational context. Then lastly, embrace and manage strategic change. These are 5 learning outcomes. Now, candidates, the content is organized in 12 topics. 12 topics. The first one is Introduction to Management. Number 2, Evolution and Development of Management Thought. Number 3, Leading as a Function of Management. Number 4, Other Functions of Management. Number 5, Environmental Analysis. Number 6, Leadership Approaches and Strategy. Number 7, Decision Making. 8, Enterprise Management. 9, Project Management. 10, Marketing Management. 11, Leadership and Strategic Change. Then lastly, Case Studies in Leadership and Management. Case Studies in Leadership and Management. These are 12 topics. 12 topics. And candidates will be covering each topic at a time. Each topic at a time. For example, the first topic, Introduction to Management, we will study the nature of management, importance of management, levels of management, multidisciplinary nature of management, roles of management as advocated by Henry Mitzbach, the changing roles of managers and management, qualities of an effective manager, management and administration. These are the subtopics under the first topics. Then in topic 2, there are 3 categories of evolution and development of management thought. Is organized in 3 subsections. Number 1 is the classical approaches to management. Number 2, behavioral management approach. Then modern management theories. The third topic, leading as a function of management, will study differences between management and leadership. We'll study attributes and skills of a good leader. We look at the delegation, responsibility, and accountability. Then we will cover power, authority, and accountability. In topic number 4, which is known as other functions of management, we will discuss the planning function, the organizing function, the staffing function, and the controlling function. Topic number 5, which is environmental analysis, we are expected to cover microenvironment, macroenvironment, internal environment, external environment, and tools of environmental analysis. Then in topic number 6, leadership approaches and strategy, we look at the leadership traits, leadership styles, leadership skills, formulation of an organization's strategic direction, differences between transactional leadership and transformational leadership, conflict resolution mechanisms, then ethics in leadership. In topic number 7, we'll discuss the importance of decision-making models, types of decisions, decision-making process, problem-solving skills, decision-making under different conditions, challenges in decision-making, effective, and lastly, effective decision-making. In topic number 8, we are expected to study the meaning and concept of entrepreneurship, entrepreneur development, enhancing creativity and innovation in organizations, methods of generating ideas, introduction to business plan, protection of intellectual properties. That is the last subtopic in the study of enterprise management, protection of intellectual properties. In topic number 9, candidates are expected to cover number 1, project management concepts. Number 2, characteristics of a project. Number 3, importance of projects. Number 4, features of projects and baseline surveys. Number 5, illustration of the project life cycle. Number 6, project planning and organizing. Number 7, project resources and costing. Then lastly, number 8, project completion and evaluation. In topic number 10, known as marketing management, we will discuss the meaning and importance of marketing. We will look at the marketing management orientation and or philosophies. We study the marketing mix. We'll discuss the development of marketing information. Number 5 is the marketing strategies. Then we have marketing research and intelligence. And lastly, international marketing and e-commerce. Topic number 11, leadership and strategic change. We will consider the meaning of change, theories of change, types of organizational change, managing resistance to change, the organizing the change context, levers for strategic change, methods of introducing strategic change, problems of formal change programs, leading change is the last subtopic under leadership and strategic change. Then lastly, there is a case studies in leadership and management. Case studies, we will discuss or look at different case studies in leadership and management. So candidates, these are the areas that you are expected to study in your endeavor to gain knowledge, skills, and attitudes that will enable you to apply and demonstrate leadership and management skills to grow an enterprise. And that should be done under various circumstances. You're expected to manage an enterprise under various circumstances and environments, including uncertain environments. So I hope, candidates, you will be joining us in all the lessons. We are going to cover each and every aspect of this syllabus. It is expected that as we go through this syllabus, when you join these classes, make sure you take down notes. If you have questions, you are free to post your questions. Below this syllabus, there is a comment section where you can ask questions. Make sure you also practice active recall. Carry out continuous revision. Over and above the video lectures, we have also developed the study materials, study texts, and revision books based on the revised syllabus that was promulgated in the year 2021. The books are updated and they cover all these areas that we've mentioned. So make sure you study ahead. Study ahead. Always study ahead. Make sure you familiarize yourself with the various aspects of the syllabus, and as we progress with this coverage of this syllabus, make sure you always go back, answer questions, past paper questions, because some of the topics in leadership and management were retained, because I remember I said that this subject, leadership and management, was just renamed. In the old syllabus, the paper was known as strategy, governance, and ethics. There are certain topics that were maintained, like the first one, introduction to management. There is a topic on evolution and development of management thought. Other functions of management were also retained, like the planning function. We covered it in the previous syllabus, organizing function, the staffing function, controlling function, and even leadership approaches and strategy. These are some of the topics that were retained in this current syllabus. All right. The only new topics that were introduced here I can see is enterprise management. Some subtopics are enterprise management. Project management is also a new topic, including marketing management. Though candidates in the old syllabus, when some of us were studying this course, we studied project management and marketing management. These topics have been reintroduced in the syllabus. So you can see, candidates, we have past paper questions from these areas that I've mentioned. So as we progress, make sure you revise, look at the past paper questions from our revision partners. Check our revision partner. We have past paper questions with solutions. So as we progress with the coverage of this syllabus, make sure you carry out continuous revision. Don't wait at the last minute in order to revise. No. Continue revising. When, for example, when you are done with topic number 1, go to the revision books, look at the questions that have been tested in the past under this topic, because in the revision books, we have organized the questions topically. So it's very easy for you to locate questions based on the topic that have been that we are covering in the subject leadership and management. So candidates, thank you for choosing to study with the Manifesto Publishers. We endeavor, we plan, we are ready to help you gain the required skills, the required attitudes and knowledge that will enable you meet the objectives that I read here. Remember, by the end of this training, number 1, the syllabus states that you should be able to demonstrate an understanding of leadership techniques and management principles. Number 2, you should be able to apply knowledge of leadership and management theories in organizations. Number 3, you are expected to effectively undertake management functions. Number 4, a student or candidate who passes this paper should be able to make rational management decisions in an organizational context. Then lastly, you are expected to embrace and manage strategic change. It's not just about knowing the principles or memorizing a few concepts. No, at the end of the training, it is envisaged that you should embrace and manage strategic change among the other objectives that I have read. So that is our intention. That is our purpose, to equip you with the knowledge, with skills and attitudes that will enable you to apply and demonstrate leadership and management skills that will enable you to grow an enterprise under various environments or circumstances, including environments and circumstances that are uncertain. So you can see, candidates, the training is not limited to you passing the exam. The skills that you gain here should enable you to demonstrate, to practice, to manage, to apply, to embrace, to make rational management decisions in an organizational context. So thank you one more time, and hope to see you as we continue studying leadership and management. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have two types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore maybe in this case we can say that there are different types of group structure, including number one, we have the horizontal structure. Number two, we have the vertical structure, and also number three, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, subsidiaries. So the parent company here is having direct shareholding in two or more subsidiaries. So a good example of a horizontal structure, let's assume that we have A Limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries: B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say, in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is the vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding, shareholding in a subsidiary, subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do you mean by that? Let's assume that we have 3 companies, and A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure, because the parent company here, which will be which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary, subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the subsidiary. Indirect shareholding in the subsidiary. In the subsidiary. So how do we compute that particular parent company indirect shareholding in this particular subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is the subsidiary, and then B, which is a subsidiary or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue, and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the subsidiary. Number two is you need to identify the date, identify the date when the subsidiary became a member of the group. So number two, we can say identify the date when the subsidiary became a member of the group. Became a member of the group. And basically that particular date is very, very important, because when, for example, preparing number one, when computing the goodwill of the subsidiary, you compute it on this particular date when the subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the sub-subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the sub-subsidiary became a member of the group. And actually, the sub-subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the sub-subsidiary. So therefore, you can say that the sub-subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the sub-subsidiary. So basically we are saying that the sub-subsidiary will become a member of the group on the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that you're told A Limited acquired shareholding in B maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. Therefore, in this case, we are saying the sub-subsidiary will be deemed to have become a member of the group on the later of the two dates. The date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular sub-subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the sub-subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number three, is regarding the cost of investment. Cost of investment in the sub-subsidiary. So when talk about the cost of investment in the sub-subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the sub-subsidiary. The sub-subsidiary. Now, this particular cost of investment in the sub-subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the sub-subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. Paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 80 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, in subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is a parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
Greetings, candidates, and welcome to the Manifested e-learning platform. The subject is Advanced Financial Management. We continue with the topic mergers and acquisitions. In our today's session, we're going to discuss the arguments for and against the use of mergers and acquisitions as tools for corporate expansion. Why would companies choose to merge? Why would a company choose to acquire another one as a tool for corporate expansion? Because by now we are aware that mergers and acquisitions are tools that companies use for corporate expansion, but these tools come with both potential benefits and significant risks, benefits and disadvantages, advantages and disadvantages. These advantages are what we are calling arguments for mergers and acquisitions. So what are the arguments for? The benefits. We begin with the benefits, then we'll move on to the disadvantages. Why would companies choose to merge or companies choose to acquire other companies? One reason is to increase market share. Increase market share. One obvious benefit that may accrue to a company, increasing the market share. Acquiring or merging with a competitor can rapidly expand a company's customer base and market presence. That is one benefit. Second benefit for mergers and acquisition is the economy of scale. Economies of scale. Combining operations through merging can lead to cost savings through shared resources, bulk purchasing, and streamlined processes. That can lead to economies of scale. Access to new markets. New markets. Mergers and acquisition can provide a company access to new markets and technology. Mergers and acquisitions, in other words, can provide a quick entry into new geographical regions or access to innovative technologies that would take years to develop organically or internally. Instead of a company waiting to grow organically, to grow internally, the company can choose to merge with another one so that the benefits can be enjoyed quickly. Access to new markets, technology. Number 4 benefit is diversification. Diversification. How is diversification a benefit? Now, acquiring companies in different industries can reduce risk by diversifying revenue streams. Diversification. 5 is enhanced competitive advantage. It can lead to enhanced competitive advantage. Mergers and acquisitions can lead to enhance competitive advantage by combining strengths. When companies come together, companies combine strength, that can create a stronger and more competitive advantage. 6, faster growth. faster growth. Mergers and acquisitions can lead to faster growth. Mergers and acquisitions, in other words, can allow for rapid expansion compared to organic growth. Now, the list is not complete without mentioning synergy. Synergies. The combined company, after merging, often achieve more together than the individual companies could separately achieve. We always say two are better than one. What two companies can achieve together far much outweigh what each individual companies can achieve separately. That's what we're referring to as synergies. So these are 7 benefits. Let's discuss the disadvantages of mergers and acquisitions. Disadvantages or arguments against use of mergers and acquisitions. What are the disadvantages? One is disadvantages or challenges. We have integration challenges. When companies merge, there is always that difficulty or challenges when it comes to integration, merging different company cultures, merging the different systems of a company, merging the processes. That can be a complex exercise, and that is one challenge that comes with mergers and acquisitions. How to merge the different corporate cultures, company cultures, the processes, the systems, and so on. 2, cultural clashes. Cultural clashes. Differences in corporate cultures can lead to conflicts. It can lead to employee dissatisfaction and also decreased productivity. Cultural clashes. 3, financial risks. There are also financial risks that are associated with mergers and acquisition transactions, which may involve significant debt. For a company to purchase another company, the acquirer or the predator may be required to seek for debt, which can lead to financial risks. So mergers and acquisition transactions often involve significant debt, and there is a risk of overpaying the target company, which may lead to financial risks. We also have challenges associated with complying with regulations. M&A deals are subject to regulatory scrutiny, particularly the competition laws, which can delay or even block transactions. Another challenge is associated with employee morale. Employee morale and turnover. This is yet another challenge associated with mergers and acquisitions. Employee morale and turnover. Mergers and acquisitions can create uncertainty among employees, and that can lead to anxiety, that can lead to decreased morale, and ultimately high turnover is a challenge which the management should take note of
during mergers and acquisitions. When employees are told that the company is going to be acquired, that can lead to anxiety, uncertainty, and that affects productivity, and it may increase turnover. That is disadvantage number 5. Number 6 is valuation difficulties, valuation challenges. During mergers and acquisitions, it may be necessary for the company that's merging or the company that is being acquired to be valued. So accurately valuing a target company can be challenging, and we've seen in the past companies overpaying. That is a common risk, overpayment, because payment is based on valuation. If no proper valuation is done, then company may end up being overpaid and so on, and that can be a great challenge. 7, failure to achieve synergies. Failure to achieve synergies. One of the main reasons for merging and acquiring companies is to achieve synergies. But sometimes the anticipated benefits of mergers and acquisitions may not materialize, which may lead to financial losses. That is number 7. The 8th and last disadvantage here is disruption of core business. Disruption of core business. Disruption of core business. Mergers and acquisitions can sometimes affect the operations of an entity. They can divert the management's attention. Mergers and acquisitions can also divert resources from the company's core business, and that is a challenge. So these are 8 disadvantages or arguments for and against use of mergers as tools for corporate expansion. There are other tools that companies can use when planning expansion, like what we call developing the internal processes can also be another way to expand. You understand? What we call organic growth. A company can grow organically, or company can choose to merge or acquire another one in order to achieve corporate expansion. In our next session, we will be discussing the mergers and acquisitions versus organic growth. For now, we take a break from today's lesson, where we've discussed the arguments for and against the use of mergers and acquisitions. Thank you for attending the lesson. Bye-bye. Hello and welcome back to the lesson. Today we are going to study the development of audit programs. We are going to cover 3 areas. First, we'll define audit programs. We'll highlight the purposes of audit programs, definition and purpose. Then in this lesson, we are going to highlight the components of an audit program. Then we will discuss the process of developing audit programs. Those are 3 areas. But first of all, it's important for us to understand that the development of audit programs is a crucial step in the audit planning process. It is a crucial step
in the audit planning process, translating the overall audit strategy into a detailed step-by-step set of instructions for the audit team. In our last session, we defined an audit planning strategy as a high-level framework. So after that audit planning strategy is developed, then the audit strategy is then translated into a detailed step-by-step set of instructions for the audit team. So the audit planning strategy is developed by the top level auditors in the audit firm. Then the audit program is also developed for the purposes of translating that overall plan, because the audit strategy is a roadmap. The audit strategy is it is a game plan. It is just a plan, an overall plan. That overall plan has been translated into specific step-by-step instructions that can be carried out so that the audit assignment objectives can be achieved. You understand? In other words, the audit program is a blueprint that outlines what audit procedures will be performed, how they will be performed, by whom, and when. So it is a blueprint specifically for the audit team. So an audit program, in other words, is a detailed plan of the auditing work to be performed, specifying the procedures to be followed in gathering audit evidence to achieve the audit objectives. That's the meaning of audit program. So what is the purpose of these step-by-step instructions? These are just step-by-step instructions, a program. The way you would have a program for a funeral or a program for a wedding or a birthday party, there is always a program, step-by-step, what will happen after what event. So there is that step-by-step instructions for the audit program. It indicates the step-by-step instructions for the audit team. Who will perform what? How will the task be performed? By whom? And at what point in the period of auditing the organization? So what is the purpose? What is then the purpose of an audit program? What is the purpose of an audit program? Now, one is to guide the audit team. One provides guidance to the audit team. Now, candidates, if you have a team of people working on any project, it could be an audit assignment or any assignment. It could be even just a football team or any team on that is supposed to achieve a certain end. There has to be a program. There has to be a step-by-step instructions on what each individual is going to do. So an audit program provides guidance to the audit team. Okay, it provides clear instructions to the audit staff, especially the less experienced members, on the specific tasks that they are to be that they are required to execute. So it provides guidance to the audit team. It also ensures completeness. An audit program ensures completeness and consistency. An audit program ensures completeness and consistency. It helps ensure that all necessary audit areas are covered, and that procedures are applied consistently across the engagement. It is also a basis, this program is a basis for control and supervision. When everyone is given assignment on what to do and when to do it, then controlling the work becomes possible. Supervising such stuff becomes possible because such supervision is carried out on the basis of the audit program. It allows the audit seniors, the managers, and even the partners to effectively direct, supervise, and review the work of their team members. 4, documentation. There is also an advantage or a purpose in relation to documentation of work performed. Documentation of work performed. An audit program serves as a record of the audit procedures that are carried out, which is essential for audit documentation and quality control. 5, an audit program facilitates delegation, facilitates delegation. Audit work facilitates delegation. It enables the delegation of tasks while maintaining control over the overall audit quality. Then lastly, there is the purpose related to efficiency. Efficiency. By pre-planning procedures, it helps avoid duplication of effort and ensures efficient use of resources. So that is the meaning of audit programs and the purpose of audit programs. That now makes us move to the next aspect of this lesson, which is the elements. What are the elements or components? What are the components or elements of an audit program? That's another question we need to answer. A well-developed audit program typically includes things like audit objectives. It includes specific audit procedures. It includes many aspects. But the first component of an audit program is audit objectives. An audit program must have audit objectives of the audit. There has to be clear statements of what the audit aims to achieve for each area being audited. It could be to confirm the existence or valuation of inventory. It could be to verify the completeness of revenue recognition. It could be to provide an opinion on the financial statements. There has to be an objective. So every audit program must have the objectives of the audit. And these objectives are linked to the financial statement assertions like existence, completeness, valuation, rights and obligations, presentation and disclosure, and so on. 2, specific audit procedures. An audit program must have specific audit procedures or steps. There has to be details, instructions on the actions to be taken to gather evidence related to each objective. And these procedures can include tests of control, substantive procedures, tests of detail, analytical procedures. It can also include assertions addressed, things like working paper references. You understand, candidates? Work done, you have review of sign-offs, the time budget, and so on. You understand? So we have audit objectives, We have specific audit procedures, okay, which I've said includes tests of control. It may include substantive procedures. Tests of substantive procedures comprise of tests of details. It may also comprise of analytical procedures. You understand, candidates? Then you have assertions. Assertions. Okay? We have assertions, candidates. For each procedure is often linked to the specific financial statement assertions that it aims to address. You understand? So the key elements of audit program would also have, apart from the specific audit procedures, we have the assertions. 3 assertions that are addressed. What assertions? Then there is the working paper references. Working paper references. Working paper references. We have maybe columns or spaces to record where the results of each procedure are documented in the audit working papers. We may also have done by and date columns. Done by and date. Done by and date columns. Done by and date columns. These are spaces for initials of the auditor who performed the work and the date it was completed. This enhances accountability. Then there is review sign-offs. Review sign-offs. Review sign-off, these are spaces for senior auditors, managers or partners to sign off on the completion and review of each section of the audit program. It may also have 7 time budget. An audit program may have a time budget. This is often an estimated time budget for each section or procedure that is included to aid managing the auditor's progress. Time budget. So these are 7 key components of an audit program. Now, in closing this lesson, we are going to discuss the process of developing an audit program. What is the process? We've defined what an audit program is. We've highlighted the purpose and the components. So what is the process? What are the steps in the process of developing an audit program? That's the question that we want to answer next. Now, the development of an audit program is not a generic exercise because it is tailored to the specific client and engagement based on the audit planning strategy. So the process begins by reviewing the overall audit strategy. 1. Review of audit planning strategy. The process begins by reviewing the audit planning strategy. Reviewing the audit planning strategy. The audit program flows directly from the overall audit strategy, as we saw at the beginning, which includes the assessment of the client's business, the industry, the assessing the industry, the risks, and even the planned reliance on internal controls. Then the second step is to identify significant accounts and assertions. Identify significant accounts and assertions. Step number 2. Identify significant accounts and assertions. Now, based on the risk assessment, the auditor identifies the financial statement accounts and disclosures that are most significant, that are also more significant, like existence, completeness, valuation, and so on, for each that carry the highest risk of material misstatement. Then the third stage in developing an audit program is to determine the audit objectives for each area. Determine audit objective for each area. Determine the audit objective for each area. For each significant account and assertion, specific audit objectives are formulated. For example, for accounts receivable, objectives might be to confirm the existence of recorded receivables and to ensure receivables are properly valued. So there has to be audit objective for each area. There could be objective for accounts receivables, there could be objectives for accounts payables, there could be objectives for inventory, and so on. So in developing an audit program, that has to be determined. The audit objective for each area has to be determined. Then after that is done, then we design specific audit procedures. Design specific audit procedures are then designed after determining the audit objective for each area. For each objective, the auditor designs a set of specific actionable audit procedures, and the nature, the timing, and the extent of these procedures are also determined by risk assessment, by effectiveness of internal controls, and by materiality, including prior audit expertise and professional judgment. So the procedures are designed. The specific audit procedures are designed, and they are determined by various factors, like the risk assessment. The higher assessed risks will lead to more extensive and rigorous procedures. That is a factor to determine, because the risk assessment was done previously based on risk assessment. The risk assessment that was carried out will determine the extent of the audit procedures. Another factor that determines the specific audit procedures is the effectiveness of internal controls, such that if controls are strong and tested as effective, then substantive procedures might be reduced. But if controls are weak, then the company will have substantive testing, which will be required. Another factor to consider when designing specific audit procedures is materiality. Procedures are designed to detect misstatements that are material to the financial statements. The fourth factor is prior audit experience. These are insights from previous audits of the same client, which can inform the current programs. Then, of course, there is the aspect of professional judgment. That is also a factor. The auditor's experience and judgment are vital in selecting the most appropriate and efficient procedures. So that is the fourth stage, designing specific audit procedures. Then number 5 is allocating resources. 5, allocate. After the procedures have been developed, specific procedures, then you allocate resources. Resource allocation. Allocate resources, and this may also include responsibilities. Allocate resources and responsibilities. After designing specific audit procedures, then allocate resources and responsibilities. The audit program indicates which team members are responsible for performing the specific procedures that have been developed in stage number 4. So there has to be allocation of responsibilities. Who is to perform the procedures that are developed in stage number 4? You understand? Considering their skills, considering their experience, considering the expertise. Based on the expertise, then all these resources are allocated to the employees or the audit staff. Review and approve. After allocating responsibilities, remember, these responsibilities are not carried out. It's just allocating. It's a plan. It is a program. Before the audit begins, first of all, we have the audit planning strategy. Then flowing from the strategy, we'll have the audit program. Then within that program, responsibilities are allocated and resources. Then step number 6 is to review and approve the audit program. The draft audit program is reviewed by more senior members of the audit team to ensure its comprehensiveness, to ensure appropriateness, and also to ensure that it aligns with the audit strategy and professional standards. And at this point, adjustments can be made as necessary. You understand? Then, of course, we can add modification. We can say flexibility and modification. Flexibility and modification. Flexibility and modification. Now, while a detailed plan is essential, audit programs should not be rigid. Auditors must be prepared to modify the program during the audit field work if new information or unexpected findings emerge that alter the risk assessment or even necessitate different procedures. So this is a systematic approach of developing an audit program. That is the end of the lesson. In this lesson, we've defined what an audit program is. We've identified 6 purposes of an audit program. We've also highlighted the process of developing an audit program. Thank you for attending the lesson. Bye-bye.
if we can start with task one. If you have gotten the worksheet, you should probably open it on your computer if you have access to your computer. Then we will start with the tasks. So task one says insert a new row at the top of the worksheet and insert the heading. I think here, this one I wanted to say insert the title, New Day Motors September imports. So there is a car dealer of some sort here. They've imported these vehicles. We have the cost. We probably be asked to do the duty, the shipping, and then the total cost. So what we want to do is follow these tasks, right? So if there is anyone amongst us, how do we insert a new row up here? We want something at the top of the worksheet. To insert a new row, we had not discussed this before, but I'm sure probably there's someone amongst us who will know how to do this. So I'll point at where the one is, number one, and right click on that and there will be an insert option. So just click that, you get a new row, right? So, and the same works for if I wanted to insert a new column and so forth. We don't want a new column this now, right now. So what we want to do is insert that heading. Let's see, New Day, calling it New Day Motors September imports. So what does the next task say? Format the title to be bold and size 30. So we apply some basic formatting. So to format this, we'll of course highlight it, then go to the home tab and click on bold. Then they want it size 30, we change that here. Sometimes you will find that the size you want to put is not listed here, like size 30 is not amongst these ones. So what do? We just type it directly and we get a size 30, right? So that's size 30. Then they want the cells merged in the range A1 to G1, right? I can see this font is already quite big. Maybe I should adjust the size, but let's see. Highlight this to merge the title, to merge the cells. We will highlight the range from A1 to H1. Then I will go to the home tab and click on this merge and center. So it merges it within that range. The only issue right now is that it doesn't fit, so I can adjust a bit. What I've done is drag this a little to make sure that the whole of the title shows. Okay, I hope we're together up to that point. So that is formatting. Let's see, yeah, there is one more formatting thing. We're supposed to apply visible table borders on the spreadsheet. We want some visible borders. So this part is going to be visible. So to apply borders, highlight the whole range where you want to apply the borders. Then we can again use the home tab and borders are here. So there is this font group, this ribbon, font group, borders, and click on borders and you have borders there. Okay. That's clear. So let's try do some calculations now. We are applying some of what we have been learning. And this is where I want to get some interactivity out of you. We have been told to calculate duty. The duty, the rate for the duty is 40% for cars that cost $5,000 and below, and 55% for the rest. That means for vehicles that cost above 5,000, the duty is higher, it's 55%. So if anyone can recall from our discussions, what do we need to do here? What will we be using, a formula or a function? And if it's a function, what function shall we use? Okay, let me review this one for you. Now, we talked about the if function. The if function is a conditional function. Remember here, the condition is The duty changes according to the amount, the cost of the vehicle. So if the vehicle is above 5,000 USD, duty is this. If not, it is this other one. So it just sounds like an English sentence. So we have equals, then we start at the if function. If, then we will click this. So it should read like an English sentence. If the cost is above or equal to 5,000. Okay, if the cost is above or equal to 5,000, then what happens? So we have to have a then clause. This is called the condition. If that condition is true, then we have started with a greater than, actually, come to think of it, because here it says 5,000 and below. So we need to change this to answer the question correctly. We are less than or equal to, and notice the order of these symbols. You have to start with a less than sign followed by the equal sign. Sometimes students mix them up. You start with equals, then less than, and it doesn't work. So you put them in the order in which you say them. Less than or equal to 5,000. Then the duty is 40%. If you recall from our last lesson, I remember we did a bit of that function. You have to say 40% of what? If I just wrote 40%, then I'll get the wrong answer. Or rather, I'll just get 0.4 because 40% is 40 out of 100. I need to say 40% of what? 40% of the cost. Okay, so the duty is 40% of the cost. Else, so if this value does not meet the condition, the value in here does not meet that condition, then the duty is 55% of the cost. Right? Very important to remember there. Otherwise, there are some cases where a student will work out this. They will put the 40% and not put the value. Let's just see what would happen. If you didn't put 40% of what you're trying to get, you'll get this. And then you will wonder, why is my formula not working? Because you've not said 40% of what, or 55% of what. So you can use this to actually also check what rates are being used for the duty. Anything above 5,000, you'll see it is 0.55. This one is 0.55, which is 55%. So we need to specify it is 40% of the cost. That is how we do it. Remember, we have talked sometimes about clicking on the options rather than typing them. Then when you click, that is when you're able to out of field like we have done. We can also try the next one, shipping. Shipping is again straightforward. It is 15% of the cost for all vehicles. So that one should be a straightforward calculation.